Major tax deductions and credits for individuals. In our previous video we introduced you to income tax regulations for individuals. In this video we will continue with the tax theme and look at some major tax deductions and credits which lower your tax bill if you qualify for them. Deductions reduce your taxable income while tax credits reduce your taxes dollar for dollar, and are more valuable than tax deductions. Tax deductions. There are two main types of deductions: the standard deduction and itemized deductions. You can choose whichever method gives you the larger deduction. Standard deductions. The amount for standard deduction varies based on filing status. For 2023, standard deductions are as follows. 1. Single or married filing separately, $13,850. 2. Married filing jointly or qualifying widow or widower, $27,700. 3. Head of household, $20,800 for individuals older than 65 or are blind. There are additional amounts allowed for the standard deduction as follows. Single or head of household 65 or older or blind $1,850, 65 or older and blind $3,700, married filing jointly or separately and surviving spouse 65 or older or blind $1,500. Per qualifying person, 65 or older and blind $3,000. Per qualifying person, itemized deductions. If a taxpayer's eligible expenses exceed the standard deduction, the taxpayer might benefit from itemizing deductions. Some of the main itemized deductions are as follows. A. Medical and dental expenses. 1. Deduct the amount exceeding 7.5% of adjusted gross income, AGI. 2. Includes expenses for diagnosis, treatment, prevention, and transportation for medical care. 3. Payments to doctors, dentists, surgeons, and other medical practitioners. 4. Prescription medications and insulin. 5. Medical equipment and supplies. 6. Health insurance premiums, if not paid with pre-tax dollars. B. State and local taxes, SALT. 1. Deduct state and local income, sales, and property taxes. 2. Limited to $10,000 per return or $5,000 if married filing separately. C. Mortgage interest. 1. Mortgage interest paid for a primary residence and a second home is deductible. 2. Includes interest on home equity loans and lines of credit, if the funds were used to buy, build, or improve the home. 3. Interest is allowed on up to $750,000 of mortgage debt, or $375,000 if married filing separately. 4. For mortgages taken out before December 16, 2017. The limit is $1 million. D. Charitable contributions. Taxpayers can deduct contributions to qualified charitable organizations. This include 1. Cash donations. 2. Non-cash contributions, for example, clothing and household items. 3. Mileage driven for charitable purposes. Charitable contributions are generally limited to 60% of AGI for cash contributions and 30% for non-cash contributions. Taxpayers should keep good records, especially for donations of $250 or more. E. Casualty and theft losses. 1. Allowed only in federally declared disaster areas. 2. Must exceed $100 per incident and 10% of your AGI. 3. Includes damage to home, vehicles, or personal property. 4. Includes theft losses. Above the line deductions. Above the line deductions reduce adjusted gross income and can be taken even if the taxpayer does not itemize deductions. Key above the line deductions include: A. Educator expenses. 1. Up to $300 of unreimbursed expenses for classroom supplies for K-12 educators, teachers, counselors, principals, or aides. 2. For classroom supplies and professional development courses. B. Health savings account, HSA, contributions. Taxpayers can deduct contributions to an HSA if they have a high deductible health plan, HDHP. Contribution limits for 2023 are: 1. $3,850 for individual coverage. 2. $7,750 for family coverage. 3. Additional $1,000 catch-up contribution if 55 or older. C. Self-employed health insurance premiums. Taxpayers can deduct 100% of health, dental, and long-term care insurance premiums. D. Alimony payments. Alimony payments are deductible for divorce agreements executed before 2019. E. Student loan interest. 1. Up to $2,500 of interest paid on qualified student loans. 2. It phases out at higher income levels. F. Retirement contributions. 1. Up to $6,500, or $7,500 if 50 or older, is allowed for traditional individual retirement accounts, IRA. 2. Deductibility depends on income and whether the taxpayer is covered by a workplace retirement plan. 3. For self-employed individuals, contributions to self-employed retirement plans are deductible, subject to limits. Self-employed retirement plans include SEP IRAs, Simple IRAs, and Solo 401k plans. Self-employed tax deductions. Self-employed individuals can deduct many business expenses, including home office expenses. 1. You must use a portion of your home exclusively and regularly for business in order to claim this deduction. 2. The deduction is based on the percentage of the home used for business, typically based on square footage, times expenses spent on the home for the year. Deductible expenses include mortgage interest, property taxes, utilities, repairs, insurance, and other expenses incurred for the home. 3. For example, if 500 square feet of a 2,000 square foot home is used for business, 25%, 502 thousandths, of all expenses for the home can be deducted. 4. Taxpayers may use a simplified method, $5 per square foot, up to 300 square feet, or the actual expense method described above. Vehicle expenses. Self-employed taxpayers can deduct actual expenses spent on vehicles used for business, or use a standard mileage rate of $0.655 per mile for 2023 self-employment deduction. Self-employed individuals pay self-employment tax on their business income. Half of this self-employment tax can be deducted. Qualified business income deduction. Business owners are allowed a deduction of up to 20% of their qualified business income, subject to certain eligibility rules. Other notable deductions. A. Moving expenses. Moving expenses are only allowed for active duty military members moving due to military orders. B. Gambling losses. Taxpayers may deduct up to the amount of their gambling winnings. Taxpayers should keep thorough records of all expenses they plan to deduct. This include receipts, canceled checks, credit card statements, vehicle mileage logs, acknowledgement letters from charities. Income phase-outs. Many deductions phase out at higher income levels. Taxpayers should be aware of these limitations for their specific situation. Part 2. Tax credits. Tax credits directly reduce the amount of tax a taxpayer owes, dollar for dollar, and is therefore more valuable than tax deductions. The benefit from a tax deduction depends on a taxpayer's tax rate. For example, a taxpayer with a tax rate of 15% would save $15 in taxes for a $100 deduction. A tax credit of $100 would save the taxpayer $100 in a similar situation. Here are a dozen of the most popular tax credits. 1. Earned Income Tax Credit, EITC. First up is the Earned Income Credit, or EITC for short. This is probably the most popular and most abused tax credit. The EITC is a credit for low to moderate income working individuals and families. The credit amount varies based on income and number of dependents. Taxpayers must meet the following requirements to qualify for the EITC. 1. Have worked and earned income under $63,398. 2. Have investment income below $11,000 for the tax year. 3. Have a valid Social Security number. 4. Be a U.S. citizen or a resident alien all year. 5. Not file Form 2555, Foreign Earned Income. 6. Meet certain rules if separated from spouse and not filing a joint tax return for 2023. The maximum for the EITC is as follows. 1. No children, $600. 2. One child, $3,995. 3. Two children, $6,604. 4. 3 plus children, $7,430. 2. Child tax credit. The child tax credit is paid to individuals with qualifying dependent children. A qualifying child must be under 17 years of age at the end of the tax year, have a valid social security number, and must be a U.S. citizen, U.S. national or U.S. resident alien. There are other eligibility requirements. The child tax credit allowed for 2023 is as follows. 1. Up to $2,000 per qualifying child under 17. 2. Up to $1,500 of that is refundable. This means that if the credit reduces the tax owed to zero, the taxpayer can still get back up to $1,500 as a refund. 3. The credit begins to phase out at $200,000 AGI, $400,000 for married filing jointly. 3. Child and Dependent Care Credit. The Child and Dependent Care Credit helps offset the cost of care for children under age 13 or for a spouse or dependent who is unable to care for themselves. The amount allowed is as follows. 1. Up to 35% of $3,000 in qualifying expenses for one child or dependent. 2. Up to 35% of $6,000 for 2 or more children or dependents. 3. Percentage reduces as income increases. 4. American Opportunity Tax Credit. This credit is available for qualified education expenses for the first 4 years of higher education. The credit is as follows. 1. For college expenses. 2. Up to $2,500 per eligible student. 3. 40% refundable, up to $1,000. 4. Phases out between $80,000 to $90,000 AGI, $160,000 to $180,000 for married filing jointly. 5. Lifetime Learning Credit. This credit applies to qualified tuition and related expenses and is for all years of post-secondary education and for courses to acquire or improve job skills. The credit is up to $2,000 per tax return. It phases out between $80,000 to $90,000 AGI, or $160,000 to $180,000 for married filing jointly. 6. Retirement Savings Contributions Credit, Savers Credit. The Savers Credit is available to low and moderate income taxpayers who contribute to a retirement plan, such as a 401k or IRA. The credit is up to 50% of contributions to retirement accounts. Maximum credit of $1,000 or $2,000 if married filing jointly. Credit percentage reduces as income increases. 7. Adoption Credit. This credit includes both a credit for qualified adoption expenses paid to adopt an eligible child and an exclusion from income for employer-provided adoption assistance. Qualifying adoption credit expenses include 1. Reasonable and necessary adoption fees. 2. Court costs and attorney fees. 3. Traveling expenses, including amounts spent for meals and lodging while away from home, and 4. Other expenses that are directly related to and for the principal purpose of the legal adoption of an eligible child. An eligible child is an individual who is under the age of 18 or is physically or mentally incapable of self-care. The credit is up to $15,950 per child. It phases out for higher incomes. 8. Premium Tax Credit. The Premium Tax Credit helps to cover premiums for health insurance marketplace, Obamacare, plans. The amount varies based on income and cost of the health plan. 9. Residential Clean Energy Credit. 30% of the cost of eligible solar, wind, geothermal, and biomass fuel property is allowed as a tax credit. 10. Electric Vehicle Credit. Up to $7,500 is allowed for new electric vehicles purchased. Up to $4,000 is allowed for used electric vehicles. The credit is subject to income limits and vehicle price caps. 11. Energy Efficient Home Improvement Credit. 30% of costs for eligible energy-saving improvements is allowed. An annual limit of $1,200 is allowed for most improvements. 12. Foreign Tax Credit. This credit is allied for taxes paid to foreign countries. It is limited to the U.S. tax on foreign income. Important considerations for tax credits. 1. Income limitations. Many credits phase out at higher income levels. 2. Refundable versus non-refundable. Refundable credits can result in a refund even if they exceed the taxpayer's tax liability. Non-refundable credits can only reduce your tax liability to zero. 3. Record-keeping. Maintain thorough records for all deductions and credits claimed. 4. Tax law changes. Taxpayers should stay informed about potential changes to tax laws that may affect deductions and credits. 5. State-specific benefits. Check your state's tax rules for additional deductions and credits. 6. Professional advice: consider consulting a tax professional for complex situations or to ensure you are maximizing your tax benefits. Understanding available tax deductions and credits is important for minimizing your tax liability and/or increasing your refund. We covered some of the main deductions and credits for 2023, but tax laws are complex and subject to change. You should always verify current tax laws and seek professional help for your specific situation. And this is a reminder that this video is for informational purposes only and should not be considered legal or tax advice. Always consult with a qualified tax professional for personalized guidance. This brings us to the end of the video. This is the part where we ask you to kindly like, share and subscribe. We'd love to hear what you think about the video, so please let us know by posting a comment. Stay well and see you in the next video.